You'll hear the expression zero is your hero. What does that mean? If you peg the growth in your annuity to the stock market directly or something related to the stock market, and that index that you've pegged your growth to declines, no matter how much it declines, you just don't get growth that year. You don't give back any of your principal. You never record a loss. And each year, you record your gains. If there are gains to be had, you get them that year. You lock it in. And then the gain and the underlying principal is protected going forward. So you can't lose money. Okay. You cannot lose money. You cannot give back your gains, which are locked in every single year, can be set up to lock in your gains every single year. Hidden fees. This is a very important question. You hear a lot of talk about hidden fees and annuities. If I put my money into a growth annuity, for instance, and I do a 7-year growth annuity, and the market goes to hell in a handbasket, every single year the market goes down. So each year, when I'm saying how much growth did I get, the answer is zero because the index went down. That's a scenario where the US has defaulted on its debt, or the US dollar has collapsed, or World War III has crazy historic things. But as soon that's happened, I recorded no growth for every single year of the life of my annuity. At the end of the annuity, the carrier will write you back a check for 100% of what you put in. Okay, so where are the hidden fees in that? There are no hidden fees in that. That's the type of annuity that we're talking about. Okay, lifetime income. A lifetime income is when we surrender a certain amount of money. We give up control over that money in exchange for a contractual guarantee of X dollars for the rest of our lives, or the rest of my life and my spouse's life, if you want to do a joint income annuity. Some of them are way better than others. Okay, but that's what a lifetime income annuity looks like. Okay, and those can be very powerful if you're looking at your fixed income as a retiree. If you're looking at how much are we saving every month? How much are we bringing in excess of our costs? If that's kind of a razor thin margin or not a very large margin, and with inflation over time, we're a little worried that that might become a negative number, we need another lifetime income stream. Okay, and a lifetime income annuity, converting a 401k, for instance, into a lifetime income annuity can make a lot of sense. And we'll talk about that as well. So these types of annuities constitute elegant solutions for retirees in any type of environment. But if we happen to be in an environment where the stock market is at high levels, in this case, historically high levels, our incremental returns off of very high market values should be expected to be well below historic averages. And in fact, we should be anticipating a big correction. If we're in that type of environment, this type of annuity becomes incredibly valuable as part of our solution, as part of our asset allocation solution. So let's just quickly review what we covered before on the market. You've all heard of Warren Buffett. Warren Buffett developed what's come to be known as the Buffett indicator or the Buffett ratio. He once made the statement, and I'm paraphrasing, if I take the stock market value and divide it by the economy's value, that is the single most telling, useful measure of whether or not the stock market is expensive, overvalued, i.e., risky and dangerous, or significantly undervalued, really cheap, and a great time to be getting into the market, or somewhere in between, fairly valued. The Buffett indicator. Okay, again, the economy generates the cash, right? Any asset that I'm thinking about buying, an asset, I need to be asking myself, what kind of cash flow can this asset generate for me? How long do I believe it can generate it for me? And now I need to account for the time of collecting those future cash flows. I need to discount those cash flows back to today's dollars. So I discount it back and I say, can I pay less than that number, or am I paying more than that number? So the underlying earnings, in this case, the economy, tells us something about the index itself, whether it's valuable or not. So that's all Buffett was saying. We are today at the highest level in the history of the Buffett indicator, and we need nearly an 80% correction in the stock market, the S&P 500 today, in order to get back on this trend line. It's crazy overvalued and implies a big correction, years of recovery time, significant losses we don't get back for a long period of time, and I'm going to cover that. If we look at another valuation metric, the Shiller ratio, okay, the S&P 500 divided by full cycle earnings of the S&P 500, it's at over 40 right now. Only time it's ever been higher was before the tech bubble, and we had a 75% drop in the NASDAQ from here and a 60% drop in the S&P 500. We've never been higher. Okay, again, do you know what you need to get back on the long-term average for the Shiller PE ratio? About a 70% drop in the stock market. So very close to what the Buffett indicator is telling us. We're at historic highs in the stock market, folks. Let's look at what's happened when we've had historic highs in the Shiller PE ratio and none higher than where we are today, okay, except for the tech bubble. If we go back to January of 2007, okay, that was the financial crisis. We saw a 22% drop in our money from that Shiller PE ratio high. 5 years later, I had lost 22% of my money. That's not adjusting for inflation. If I adjust for inflation, I lost even more than 22%. 10 years later, I was up 3%. Adjusting for inflation, that means I lost a lot of money. 10 years after the fact. The tech bubble, peak Shiller PE ratio, dropped almost 40% over 5 years. I was down 40% before accounting for inflation. 10 years, I was down 53%. 1966 inflation crisis, high inflation, the Fed started to tighten. I lost 30% of my money when the Shiller PE ratio hit that peak in 1966. 5 years later, I was down 30%. 10 years later, I was down 53%. You can see what some of these other crises did. Again, all I looked at was when the Shiller PE ratio got to historically high levels, well above normal ranges, and none of them were anything near where we are today. When I looked at those points in time, I said, what happened to my money 5 years later? And what happened to my money 10 years later? These are crazy numbers if I'm a retiree. I don't have 5 to 10 years. I can't be down 39, 40, 50% in the next 5 years, down similar levels, 10 years. I don't have that kind of time to recover. I think if we quickly review some of the other crises, actual crises that cause big declines, peak to trough, and I adjust for inflation and ask myself, how many years did it take before I was just back to where I was before the correction started to happen? How long did it take just to break even, get back to where I was? 19 years, 30 years, 24 years, 16 years, 7 years, even 7 years. Do I have that? If I'm retiring, could I afford to lose a bunch of money and not just get back to where I was for 7 years or more? For most of us, that answer is no. So we are at levels in the stock market where if you're not discounting a 50, 60% correction, you're really not paying very close attention to basic measures of valuation. Okay, if I asked you, could I afford a 20 to a 50% decline on my nest egg if I knew it was going to take at least 10 years to get it back? All of us would say no, I couldn't have. That would radically change my retirement plan. But if we look at most people's portfolios, if you own a 401k, if you own a retirement account, if you own REITs, pretty much every asset class other than cash and precious metals, you're being told by financial advisors you're diversified. Overwhelmingly, when you're being told you're diversified, that's based on looking at how those asset classes that you're in correlate with each other in normal times. The correlations are low. That would allow a financial advisor to tell you This is diversified. This doesn't move with the stock market. But the only question you need to be answering or should be answering is what's the correlation when the market's under stress? When the market's collapsing, do REITs hold up? No, they don't. They don't. Nothing holds up except cash and precious metals. They auto-correlate during the panic. Okay, everybody's running to cash. So you thought you were diversified. You thought you had some downside protection by being diversified. And you don't learn until you actually needed that diversification that you weren't diversified at all. I can show you that data in spades if you'd like to see it. Okay, so let's look at an example. How can an annuity solve for this? Again, I said it's an elegant solution. This is a lifetime income annuity. Okay, so let's start with that. If I was a 62-year-old, this is Delaware Life. Okay, their True Path lifetime income product. One of my favorite lifetime income products. If you're a 62-year-old male and you put in $500,000 into a lifetime income annuity, in this case, he wanted to start his lifetime income in 9 years. You don't have to wait 9 years. You could do it in as little as a year, but every year you wait, you get a larger amount of lifetime income. And when you look at how much larger, with all of that known up front, it's effectively guaranteed returns. The longer I wait, I'm getting 8, 9, 10% guaranteed growth in my nest egg. That's how much your lifetime income increases by waiting that extra year. So $500,000 for a 62-year-old male. 1 year later, that individual would get $40,432 paid for the rest of their life. If he waited 2 years, he'd get $44,000. That's a 10% increase in my lifetime income. That's a pretty good return if I'm able to wait that extra year. If I wait 7 years, I'm up to $65,000. Look at the compounded returns from $40,000 to $65,000 over a 6-year period. Those are really attractive compounded returns, especially in the context of our starting point being one of the most expensive stock markets in history. So again, risk reward, cost benefit. This is a wonderful product. This last column is another feature of this product. If I become chronically ill, and let's face it, as we get older, the risk of chronic illness where I need help with any 2 of the 6 daily tasks of living, you can Google those, they're standard definition, bathing yourself, dressing yourself, etc. If I need help with any 2 of those 6, I get an income doubler for 5 years. So I get twice as much lifetime income for those 5 years. And in year 6, I go back to the lifetime income that I already had. That's a valuable rider that's included. So that's a lifetime income annuity. Again, in certain circumstances, that can be a really valuable thing. How many lifetime income streams do you have that you cannot outlive? Cannot outlive. Other than Social Security, most of us don't have any lifetime income annuity streams. So this is one solution. What about a growth annuity? What about an annuity where I don't want to give up my 500,000. Lifetime income, I'm giving it up in exchange for that lifetime income. Now, if I died in 2 years in the lifetime income, most of my account value back with the carrier is still intact, and that would be the death benefit that went to my loved ones. So you're not giving it up in that sense. But you're giving up control of that money by entering into a lifetime income annuity. In a growth annuity, okay, fixed equity indexed annuity. Again, I can't lose any money. Guaranteed I cannot lose any money. Now, carrier risk is another question. Okay, I could lose money. What if the carrier went bankrupt? And the state insurance for annuity providers and the industry insurance for annuity providers ended up not covering my annuity. Very unusual, by the way, for an A-rated carrier. I don't know if I can think of one. I can think of a B-rated bank that had annuities that people bought into that went bankrupt. Imagine that happening. We don't even traffic in B-rated companies. A B rating doesn't scream risk, by the way. It doesn't. That's considered good. but I wouldn't touch that with my lifetime savings, my nest egg. I wouldn't go near anything less than an investment grade carrier. That's all we traffic in. That's what security benefit is. That's the name of this carrier. So what if I wanted to say, I don't want to lose any money. I want to take that off the table. Well, if I peg my growth with security benefit in a 7-year or a 10-year fixed equity indexed annuity, I'm locking up my money for either that 7-year period or that 10-year period. Okay, if I just change my mind and want to take it out, they'd hit me with a surrender charge. So we don't want that to happen. So we don't want to put money into a fixed equity index annuity that we're not pretty confident we'll be able to keep in there. If I got really sick, I'd be able to take it out, by the way, sooner than the end of that 7 or 10-year period. But so 7-year, 10-year, I can peg my growth in this case to what's called the UBS Multi-Asset Inflation Awareness Index. And I can peg my growth to lock it in every year, or I could lock it in every other year. They'll give me, sorry about the noise in the background. They'll give me up to 200% of whatever that index does if I do the 1 year lock in my growth, and they'll give me 285% of it if I do 2 years. So what I did in this particular example is I broke half of it up into the 1 year and half of it into the 2 year because I didn't want the client to go 2 full years without getting some growth locked in and protected. So we layered it. So now he's got some growth locking in every single year. 11.39%. That's the most, that's the average return over the last 10 years. And that happens to coincide with the worst 10 years when we back test over the last 20 years, the worst 10 years out of that last 20 years, pegging your growth to that index, it averaged over 11%. Now, that doesn't mean that's what it's going to do over the next 10 years. And I actually like the S&P 500 as my growth, my crediting option. You've got 30 different things you can peg your growth to. If you did the S&P 500, and every year, what did the S&P 500 do? Well, I just said we're worried about a 50 to 60% drop in the S&P 500, but that doesn't hurt me. I get up to 9.25% from the S&P 500. So if it's up to 9.25, that's what I get. If it's more than that, I get more than that. How many 10, 11, 15, 20% returns in the S&P 500 do you think we're going to get given the historically high levels of the S&P 500 that I discussed earlier? So I really like that I could lock in the S&P 500 and get up to 9.25%. That's not what's in this illustration. Actually, this UBS Multi-Asset Inflation Awareness Index illustrates extremely well. So the 500,000, based on the last 10 years performance, pegged to the UBS Multi-Asset Inflation Awareness Index, that 500,000 by the end of the 10 years is worth 1,464,000. That's what it's worth based on that historic performance. That's more than protecting yourself against inflation. Okay, that's substantial growth. And what I would say to everybody who's considering a growth annuity is I'm doing it based on the risk reward. I'm expecting 6 to 8%. Even that's not guaranteed, but that's what I think I'm going to get. And I'm comfortable that that's what I'm likely to get. I could get double digit. Okay, my upside is in double digits. My downside is I don't get any growth, but I'm guaranteed against losses. That's my downside. I can't lose money. If I'm a retiree in one of the most expensive markets in history, that's a really compelling risk reward scenario. So it's okay if some of this was a little bit confusing, okay? But if it sounds interesting, okay, I get 6 to 8% likely. I can't lose my money. And 11+%. Think of that as my upside. I can do that in this type of a product. That sounds interesting to you? and I think it should. What we've done is back to that shift from wealth creation to wealth preservation mode. This accomplishes that. Okay. The idea that I've got zero correlation with market declines, that's incredibly difficult to get other than cash, which doesn't generate decent returns over time. Don't even keep up with inflation for the most part. Long-term CD rates are 2%, even though they've been higher in the last couple of years. So I get a zero negative correlation in the years when the stock market goes down, but I get up to 9.25% if the stock market goes up. We've now accomplished what I said is so difficult to accomplish. Diversification is hard, and it's misleading because you're led to believe you've got diversification. I've got protection if the stock market goes down because 70%, 80% of my money is in something other than the stock market. And then we have a 50% drop in the stock market, and I see that all of those other things went down almost 50% as well. I didn't have the diversification. You have that diversification contractually here. So again, risk reward, very compelling, very attractive. So as I said at the outset, a fixed equity indexed annuity or a lifetime income annuity with a investment grade credit rated carrier. Okay, so we minimize the carrier risk. It's as close to zero as it can be. These are some of the safest, most conservative companies that you're ever going to find. These insurance companies, these A-rated insurance companies. The right type of annuity with the right carrier is an elegant retirement solution in any market. But in a market where the stock market is at historically high levels, and there's no question about that. That's not a controversial statement by me. You can demonstrate that a million different ways. In that type of environment, this type of solution, it's off the charts in terms of risk reward. So if you think this is interesting enough to have a one-on-one conversation and discuss it further, to try to figure out if this might be a fit for you. It's not a fit for everybody. Okay, be really clear about that. It's not. Some of us just aren't even suitable for it. We couldn't get it for you if you wanted it. But if you think it's worth having a conversation to see if this might be a part of your retirement solution, a part of it, your retirement needs to be an asset allocation decision. I don't put all my assets in any one thing. If you want to explore that, let us know and we'll set up a conversation, we'll set up a call and see where we go from there. That was my contact information. So with that, Brian, Lee, you guys want to jump in here? Anything that I said you think warrants some clarification or elaboration?
So Jay, I do have a question that was shared, and it's related to required minimum distributions, RMDs.
Yep.
Basically, are they required on annuities?
If you've got qualified money and we roll it over into an annuity, what's known as a qualified rollover, there's no taxation involved in that. Let me just be clear about that. It does not relieve you from RMDs. RMDs are still in play. Okay. But even if you do a fixed equity index growth annuity, you can withdraw up to 10%, including your gains in the products that we're talking about. Every year, you can withdraw up to 10%. And that's more than adequate to fulfill your RMD obligations, regardless of what you're putting in. So yes, you do still have to comply with the RMDs. But you can do up to 10% withdrawal of that security benefit growth annuity with no penalties whatsoever. So you've got enough liquidity in